You hear it all the time on the news, right? It's like this constant drumbeat. The Fed is raising rates. But what does that actually mean? I mean, how does a group of people in a boardroom actually change the interest rates that affect all of us? Well, today, we're going to pull back the curtain on one of the most powerful mechanisms in the entire global economy.
It sounds so simple, doesn't it? The Fed is raising interest rates, almost like they just flip a switch somewhere. But have you ever really stopped to think about it? How? What is the actual physical lever they are pulling to make that happen? Because it's definitely not a magic button. It's a fascinating process, and that's exactly what we're going to demystify right now. Okay, so to understand how central banks can pull this off, we have to start with a really fundamental choice. It's a choice that every single one of us makes with our money, whether we realize it or not. It's the core trade-off between holding cash versus holding something like a bond.
Let's just break this down. On one side, you've got money, the cash in your pocket, the money in your checking account. Its number one benefit? Convenience. You can use it to buy stuff right now. The big downside? It just sits there. It earns you absolutely zero interest. Then, on the other side, you have bonds. You can't use a bond to buy a cup of coffee, but it pays you interest. So there's this constant tug of war between the convenience of cash and the potential to earn a return.
In this collective decision that we all make, how much of our wealth we want to keep in a spendable form versus tucking it away in bonds, well, that actually has a fancy name in economics. It's called the demand for money.
Now, this demand isn't just random. It follows a really predictable pattern, and we can show it with this graph. See that downward sloping line labeled MD? That's all you need to focus on. It shows a super simple relationship. On the vertical axis, you got the interest rate, and on the horizontal, you have the amount of money people want to hold.
And the logic here just makes sense, right? When interest rates are super high, the reward for owning bonds is awesome. You're much more willing to give up the convenience of cash because you're earning a great return. But when interest rates are really low, that reward is tiny. So why bother with bonds? The convenience of just having cash ready to go becomes way more attractive. So high rates mean low demand for cash, and low rates mean high demand for cash. Simple as that.
Okay, so that's one half of the puzzle. That's our side of the equation, the public's demand for money. But now let's bring in the other major player, the central bank, which controls the supply of money. This is where it all comes together, where demand meets supply and the interest rate is born.
All right, let's build this up. We'll start with that same money demand curve we just talked about. Remember, this line just represents our collective preference for holding cash at any given interest rate. And now we add the other half of the story, the money supply, or MS. And you'll notice something kind of weird. It's a perfectly vertical line. Why? Well, that's the key. Unlike demand, which changes based on the interest rate, the supply of money is fixed at any one time. It's a specific amount decided by one place and one place only, the central bank.
And here it is. This is the big reveal. The interest rate you hear about on the news is determined right there, at point A, where the public's demand for money perfectly crosses the supply of money that the central bank provides. It's the equilibrium point. It's the magic spot where the amount of money people want to hold is exactly equal to the amount of money that exists. And this brings us to the single most important takeaway from this whole model, and it's a direct quote from our source material. In the short run, the central bank determines the interest rate. That's it. By controlling the supply of money, they control where that vertical line is, and by doing that, they control exactly where it crosses our demand curve. They set the rate.
So we figured out that the central bank sets the interest rate by controlling the money supply. But we still haven't answered that first question. What's the actual lever? How do they physically move that vertical line left or right? Well, let's open up the toolbox.
The main tool, the one they use pretty much every day, is called open market operations. Now, I know that sounds super complex and jargony, but the idea is actually very simple. All it means is the central bank either buys or sells government bonds out on the open market, just like anybody else. The difference is, when they do it, the impact is massive.
So let's say the Fed wants to lower interest rates. They'll do what's called an expansionary policy. Step one, they go out into the market and they buy government bonds. Step two, and this is the absolute key to the whole thing, they don't pay with existing money. They pay for these bonds by creating brand new money out of thin air, which then gets deposited into the commercial banks' accounts. So the total amount of money in the economy goes up, and that pushes the interest rate down.
So what does that look like? Back on our graph. Check this out. The central bank bought bonds, injecting new money into the system. That literally pushes the vertical money supply line to the right. And as you can see, the new place where the lines cross is lower. We get a new, lower interest rate. It's a direct mechanical process.
And what if they want to raise rates, which we're hearing about all the time these days? Well, you guessed it. They just run the same playbook, but in reverse. It's a contractionary policy. The central bank sells government bonds it already owns. Commercial banks buy them, and the money they use to pay for them gets sucked out of the financial system. The total money supply shrinks, and the interest rate goes up.
So this whole system seems incredibly powerful, almost foolproof, right? And, most of the time it is. But there's this really fascinating edge case, a situation where this incredibly powerful lever can suddenly just stop working. Let's take a look at when the tool breaks.
This strange situation is called the liquidity trap. It happens when the interest rate is already at or extremely close to zero. And just think about it for a second. If bonds are paying you 0% interest, there is literally no reason to own them instead of cash. Cash gives you the same return, nothing, but it's way more convenient. So people are perfectly happy to just hold cash. This isn't just a theory either. This was a huge real-world problem for Japan for decades, and for the US and Europe after the 2008 financial crisis.
And on a graph, this is where things get really weird. You can see how the demand curve totally changes. Once the interest rate hits zero, the curve just goes flat. This means people are willing to hold any amount of cash the central bank wants to create. So if the bank tries its usual trick, buying bonds to increase the money supply and shift that vertical line to the right, well, look, nothing happens to the interest rate. It's already at zero and it can't go any lower. The tool is effectively broken.
And this leaves us with a massive economic challenge. The central bank's main way of steering the economy depends on its ability to change interest rates. So what happens when its most powerful, most used tool simply stops working? Answering that question has been one of the biggest challenges for economic policy in the modern world. Thanks for joining me for this explainer.